Which way from here is the title of the presentation. I think it's apropos. We're at a place where it's not entirely clear where we go from here. We heard that even from Jerome Powell today from the Fed in his comments, hinting that the Fed's going to pause their interest rate increases just to try to collect information and kind of figure things out as they try to figure out which way from here. So I'll jump into it. Just to give an overview of where we are so far year to date, to look at the equity markets. It's been a while since we've been able to look across the board and see positive returns across the broad global equity indexes. The S&P 500 is up. It was up 8.6. It's down a little bit from there, but nonetheless, still a really strong start to the year. Much better than the Dow. The NASDAQ is, as of May 1st, was up nearly 17%, really driven by mega cap technology stocks primarily. And we saw more good news today from Apple. They beat expectations in terms of earnings and sales and announced a stock buyback, I think $90 billion, or $9 billion, $90 billion. In any case, it's been the mega cap technology stocks that have led the way for the NASDAQ. And if you look at that last line, the MSCI ACWI, that's the All Country World Index. That just is an index of all of the stocks across the entire global economy. And it's also positive, up at about 7.5%. If we look at the Dow, or if we look at the S&P rather, the sector performance, we can see kind of a broad-based positive participation. If you remember last year, energy stocks really were the only positive sector for 2022. And this year, it's a much broader participation led by, again, technology stocks or information technology. Consumer discretionary, the stuff that we buy on a day-to-day basis, is up nearly 15%. It's been a really important driver overall in the market and GDP. And then communication services, that includes things like Google and other, again, tech companies have done really well so far year to date. If we look at interest rates, one of the bellwether interest rates that we follow, of course, is the 10-year Treasury yield. And today it's trading at about 3.4%. This graph just gives you a sense of the context of where we've been on the 10-year Treasury yield. The real story in terms of interest rates and treasuries is the yield curve. And we've talked about this in the past, that normally you would see an upward sloping yield curve where short-term rates are lower than long-term rates. But today we still have an inverted yield curve. It's been this way for months. So one of the ways that we look at the yield curve is just to compare the yields on a 2-year Treasury compared to a 10-year Treasury. Normally, we would see, again, that the 2-year Treasury would have a lower yield than a 10-year Treasury, but that's not the case, hence the inversion. Today, the 2-year Treasury trades at about 4.05%, and again, the 10-year Treasury at 3.4%. So that's a negative inversion of about 65 basis points. It was broader earlier in the year, and at the end of 22, it's narrowing, but nonetheless, we have a inverted yield curve. We've also talked in the past at how reliably predictive it is of an upcoming recession. It's also really the source of the problems that we're seeing with many of the banks that are under pressure. So the yield curve is something that has our attention for sure. And just while we're talking about interest rates, here's the mortgage interest rates for a 30-year fixed rate mortgage and a 15-year fixed rate mortgage, just to give you a sense of context on interest rates. Clearly, interest rates have been driven by the Fed and what the Fed has been doing in terms of their program. And even today, we had an announcement from the Fed that they increased the Fed funds rate another quarter of a percentage point. And we've talked in the past that the Fed really is managing a program to try to achieve two objectives. One is price stability, or in other words, managing for inflation, to try to keep inflation at that 2% target rate and to maintain full employment. And the inflation data that we're receiving, and as part of Jerome Powell's press briefing today, he had talked about positive, welcome reduction in monthly increases in inflation as a primary driver of their decision on what their program will be. Again, they increased interest rates Fed fund rates a quarter of a percentage point today, but gave a strong hint that there would be a plateau now. There would be a pause to see what teeth, what comes from the follow from these interest rate increases. So I would expect to see that the Fed will take a pause. This may be the highest point in terms of this cycle. We'll see. Again, if you look at inflation, it's been a bumpy ride for us, and it really has been a big driver for the market, but it's improving, as the Fed had said today. The March print on CPI, which is a measure of inflation, showed that there was a 5% growth in March year over year if you just take out food and energy. And if you just look at the month-to-month increase, it's about 3.6%. So it's even better than the year-over-year number. So it is positive, and it's encouraging for sure, as the Fed had said today. So their interest rate program is making progress on inflation. And again, the Fed has targeted a long-term inflation rate of 2%. So there's definitely more work to do. The other responsibility of the Fed is employment. And you can look at it in terms of unemployment, the negative, or in terms of just the health of the job market and the market's ability to add jobs. And this graph just gives us a sense of there's a stability in the job market. There's a stability in unemployment right now at about 3.5% to 4%. And so again, it's another encouraging sign that the Fed's able to raise interest rates and bring down inflation, but yet not upset the job market completely. But it's a mixed bag, really. When we start to look at other things that are important in the economy, like the gross domestic product, we see that there's a definite slowdown in GDP. In the first quarter of 2023, GDP was up just 1.1%. And if you look at the components of that, it's consumer spending that really is driving the resiliency and that small growth in GDP. Business investment and some of the other traditional drivers are just not there. They're anemic. It really is the consumer. So it's something to watch. We talk about a recession, we talk about a soft landing, and we're looking at gross domestic product and just seeing if the economy can hold in there despite the Fed's program. Another area, or another thing that we're looking at is earnings, corporate earnings. And we've seen a decline in corporate earnings over the last 3 quarters, which points to an earnings recession. By definition, earnings with a negative growth rate, and this is a graph of the growth rate of earnings, a negative growth rate for 2 quarters or more is the definition of an earnings recession. So we're already seeing corporate earnings come under pressure. And of course, security prices are a direct result of corporate earnings. So it's again, a mixed bag. This is something that is of concern, especially when we have elevated price earnings ratios in the market today. Another area of concern, and we've all followed the banking industry, and what's happening there is that banks are making fewer loans or have fewer loans on their books. And it's happening for one of two reasons, neither which is good. Um, One reason is that banks are lending less. There's a credit crunch. They're more discriminate. They're in terms of who they're lending money to and for what reasons. So there's a bit of a credit crunch happening right now. But more concerningly, large corporations and businesses are investing less in their business. They're taking out fewer business loans. So there's just fewer loans on the books, and it's a concern. If it's more difficult to get a loan, and and companies see less compelling reasons to take out a loan to invest in the business, that spells dark clouds going forward. So it certainly is something to watch for. I think that we always see recessions, and they're gauged after the fact. We've already seen that we're in an earnings recession. So I was interested in just thinking about what happens to stocks in and around before and after recessions. And this is a chart that just looks at different recessions going back to 1953 and the market returns during a recession, before, and then after a recession. And clearly 2022 was a difficult year for market returns. My sense is that we've seen the negative returns, a lot of the pain that we would expect before a recession. We're really entering a place where we can be coming out of a recession. So as we just think about where we go from here, it's a mixed bag. We've got some positives, some negatives. The Fed sees it the same way. They're going to take a pause. But the hope is that going forward, we'll see better returns going forward. So just to try to end on a positive note there. In terms of performance for the models, as you know, the foundation has three primary models: the conservative, moderate, and aggressive. And if we look at performance as of the end of April, the portfolios really have hung in there quite well. The aggressive model has done better than its benchmark in the 1, 3, and 5-year period. The moderate model in the 1 and 5-year periods, and the conservative model has hung in there really well also. And over a longer period of time, just really right on top of its benchmarks. And we're able to achieve a benchmark or a market-based return, and to do it in a way that's compliant, aligned with Methodist disciplines for investing.